Welcome to this episode number 28 of Your Next Trade, called today Bull 16 VIX. So what we're going to have this weekend is we're going to have probably another bank going under in the US with the First Republic FOMC, which is going under and probably is going to be taken over by some other banks. Since we've seen the lows of those regional banks in the early March, the market has been going much higher and volatility has been going on the way down. So the first thing that I would like to highlight in this weekly video is how the correlation between volatility and the S&P. So this is here the chart where on the left hand side we got the VIX, which is inverted from the highs here to the lows, and on the right hand side we get the S&P. So this is not completely a crime chart, but that is to give you the correlation that we had over the last year between the VIX. When the VIX goes lower, here, so the VIX goes lower this way, the S&P goes higher, and vice versa. So strong correlation between the two. And as of yesterday, the VIX closed at 15.8% roughly, so around the 16%. So if you're not familiar with the rule of 16%, I strongly advise you to watch the videos that will be in the link below or at the end of this YouTube video. So in other words, when the VIX is pricing 16% for the next month, there is a 68% chance that the S&P will be moving by roughly 1%. But what we have seen over the last 6 weeks or so is volatility has been clearly coming down. There has been an appetite for assets, for taking more risk, and that is true for stocks. Volatility around 16%, S&P that closed at recent highs, 4,200, close to this trading range that we had recently. So despite the banks meltdown for the regional banks that we had in March, market has been really doing very well. One of the reasons is pretty clear, is the first, the Fed has been putting new money in the system. It's not in the form of QE, but by putting liquidity, by bailing out those banks that mechanically putting new money in the system. And as well, some economic numbers are not as bad as what could have been feared like a couple of months ago. I think the story is still the same. We're going to have a recession in H2 that is well telegraphed by the central banks, by the Fed, and we have many leading indicators that are telling us that H2 is for recession. So what about the year-to-date asset performances? The picture is more or less the same. We are close to the double digit for both the S&P and the Nasdaq. Europe with the Euro stocks, the stock 600 is still outperforming. But what was interesting from this week, as we're going to see later, is actually Europe was not as strong as US, which is a bit of a non-correlation or a stop of the correlation that we had so far. Dollar versus most currencies, so weakening. We have been weakening similarly, as I said last week, between 1 to 3%. Bitcoin, Ethereum, crypto, very, very strong. And then I think this is really the interesting part, which is WTI and copper. So if you want to believe that the economy is strong, you should have a strong WTI, you should have a strong copper, plus, strong economy and a strong China should lead to strong commodities price action, which has not been the case. So clearly to me, it's not like the economies are doing so well. And as we're going to see later, the GDP is a bit of confirming this picture. So what about the week-to-date asset performances? A bit misleading between the start of the week and the end of the week. So we closed the weekend on the S&P up roughly 1%, and same with the Nasdaq. But the move was from the GDP onwards, from Thursday onwards, where we had a strong Thursday and a very, very strong Friday, where we went up by 2 to 3% on those two indexes. As I said, we start to see a bit of rotation between indexes. So far, Europe was always leading, and that has not been the case for the week. That was even more true yesterday, where we had the European GDP which were flattish, and actually Germany was flattish, which tells you, there is maybe a start of the outperformance of Europe, which I would love to see, because as you don't know, I've been short Europe for quite a long time. Currencies trading a bit flattish. What I think was interesting for the week is actually the yen. The dollar yen. So the yen was weak. We had the Bank of Japan meeting on Friday morning, and it feels very much like we are going to have a status quo in terms of Bank of Japan policy, at least for the next 3 months. Even if they say that they might change and again they might tweak some of the policy, it's very much like a very accommodative Bank of Japan, which will lead, due to the differential of rates between the US, or I should say between Japan and the rest of the world, which leads into a weakening of the dollar, of the yen. Same picture on the weekly performance, looking at the WTI and copper. WTI down, copper down. So if you want to sell me that the economies are very strong, then there is clearly a divergence between the two. So in the year-to-date industry performance, the story is more or less the same. We're going to have the technology, semiconductors, the big winners. But as I said over and over the last months or so, semiconductor, which was a leading sector, a leading industry, has not been leading that much recently. So the market is looking for those new leaders. On the other end of the spectrum, the regional banks, the banks. So as I said, again, FOMC will go under this weekend. And that tells you that probably we're going to have some other banks. So this is not over for both the regional banks and the banks meltdown, or at least the issues that they have these days. What about the week to date? I think the week to date is very interesting because we got the S&P here. So we got the S&P roughly up 1%, and you see how many sectors or industries have been underperforming for the week. So that tells you what? That tells you that the market breadth, meaning how many winners we have, how many losers, is very much skewed towards the losers. So very much the market is driven by very few names, very few industries. So here we can see telco, but what is telco? It's mostly Meta, Facebook. We're gonna have a bit of home builders, but as you can see, you get many losers here. We got solar, so big. All similarly to semiconductor, solar used to be one of the leading industries, and we had some bad numbers from Ep28 and SEDG. So clearly, market is very much driven by very few names, and that tells me that it is not such a healthy market. What about the year-to-date and week-to-date sector performance? So week-to-date, similar. This is Meta mostly, so Facebook here. Then we're gonna have a bit of IT, obviously, because the FANG of this world are outperforming. Other end of the spectrum, utilities, because in the utilities, in the XLU, you're gonna have some renewables, and the solar, as we know, or maybe you don't know, have been really struggling for the week. On the year-to-date picture is more or less the same. So now switching into rates, because we want to be moving from one asset to another. Looking at the US 10-year, so we are at 3.43 as of yesterday. If you look at the trading range, and it's a bad word because there is no technical analysis on the 10 years, as I said last week, but we are getting closer to the recent lows in terms of yields that we had over the last 6 months, which are between 320 and 340. Why? Because inflation has been coming down, and we are expecting that the hiking cycle from the Fed is coming to an end. Having said that, to go below the 3.2%, you will need to see more inflation coming down. What about the 10 versus the 2, which is the a massive inverted yield curve? We are standing at minus 58 bips, so minus 0.58. 8%. In other words, inverted, that has been working very well over the last 40, 50 years as a leading indicator. What about the Fed expectation? So we move from the euro dollar to the SOFR. What is the picture telling you? And what I wanted to do for this weekend is comparing what we had at the end of December 2022 versus today. So if you look at the June, if you look at the December, the levels are pretty much the same. So in other words, what the level that we have these days are very much the same as what the expectations were at the end of December, which was the peak of the hiking cycle from the Fed between May and June. So this is what we're going to have. We're going to have 25 bips in May, maybe another 25 bips in June. At the moment, the market is pricing something like 30% chance of a 25 bips hike in June. But this is more or less the picture. But there is not much difference versus what we had last year in December. What is interesting is if you compare again the June, which is at 94.92 versus the December 95.55, you get roughly a 60 bips difference between a rate cut of 50 bips to 60 bips. So on one hand, as I said, over and over, the Fed is saying, we're not going to be cutting rate for this year. And the market is saying, from June onwards, we're going to have actually the Fed that will have to cutting rate. So again, either you're going to have inflation that's going to be plummeting, or you're going to have the end of the world coming. So what is the equity market pricing so far? We're going to be fine. Q1 is a one-off. H2, don't worry. And what we have from the rates market is actually H2 is going to be very good. My experience over the last few years is the equity market is more short term. So we used to have, looking at 3 to 6 months in advance. And now the market is literally looking at what's going to happen in 2 days, in 3 days, in a week time. You can see that with the options that we used to be taking position 1 to 3 months now. Most market participants will be taking, daily options or weekly options. So the market reacts more and more at the last minute. That was the same in February 2020, where we started to have the news from the COVID that COVID was coming to China, that it will be bad, and really the market waited the last minute, really to the Monday to close position, to sell off. What about the VIX? Looking at volatility. So as I said, we are now around the 16%. So that's 15.78. So that's the rule of 16. Watch the video after. That is interesting. So the volatility has been coming lower and lower. Another way to look at volatility is it tells you that market participants might be more confident about the future. So if you look normally at the bull market, this is why I call this video VIX 60 bull VIX 6 VIX bull 16 VIX is in a bull market. Normally, the implied volatility, let's say, will be between 10 and 17%. When you are in the bear market, you're going to be above the 16, 18%, and you're going to have, 20, 25%. So how the volatility is pricing these days, the market is very much like a bull market. You get very low volatility, both implied and realized. So pricing not much of a risk on an intraday basis and for the near future. Again, I think the market is very much badly pricing, but you can't deny that over the last 2 to 3 months, the best trades have been to be selling volatility. So every single day, every single week, every single month, if you've been selling straddle, if you've been selling volatility, you've been making very good returns. What about the VIX term structure? It's a bit steepening now. So that tells you that actually the market is still pricing something to be happening in the future. The 9 days VIX, so going into short-term volatility, higher than last week. Why? Because this week we had a bit more volatility after the option expiry. So as I mentioned last weekend, after the Friday of the OPEX, very often we have a spike in volatility. So that was true from Monday after close to roughly Wednesday. We got a couple of days of higher volatility. And so we went into the 18, 19% for the for the VIX 9 days, and then we came down. So what I would like to jump on now is on the technical analysis. So technical analysis, I always call that a bit dodgy, but just to give you a feel of the price action. And as we are at the end of the month, I think it's interesting to be looking at the chart with the month on a monthly basis. So if you are on TradingView, you just change here, you go into 1 month. So this is for the S&P futures, and as we can see, we are close to this. We are at the top of this trading range that we are so far. The difference is obviously the this candle is pretty good, because we are closing at the highs. Having said that, for the time being, nothing is broken. It feels to me like because the market is looking for more pain, that it might squeeze higher. If you look at the Nasdaq, the picture is okay. No, I mean, I don't know if it's okay, to be honest. It just feels that last month we got a strong candle. For the time being, if you jump into the Russell, very much the picture is we are still indecisive. If you look here at the Nasdaq versus the Russell, and if you look about the range, so we are at the top of those range. You can't deny that the price action is better than it was a couple of months ago. I think what we are missing from that picture is two things. Is we are missing the volumes. So the volumes have been pretty poor, and the market breadth is absolutely is very, very bad. So for the market to push much higher with a lot of traction, you will need two things that are missing, which is better market breadth, or advance versus decline, and a better volumes. And those are the two things that we are missing. So maybe you're gonna have a squeeze and some trap, but I don't think that this technical analysis tells you that this is very healthy. Emerging market, not really much of color. Looking at the stock 600 picture is pretty much okay. DAX as well, and I should say actually more than okay, even if I'm short. Very strong. What about CL1? CL1 for WTI, not that strong at all. So we have been trading in this 72, 82 range mostly, even if last month we had the sell-off into 65. But again, I go back into the idea that people are trying to push, which is, CL1 should be much higher because, the economy is restarting. We need to keep in mind that over the last 3 months, the OPEC cut production by 1.5 million barrels. So that represents roughly 1.5% of the supply. And despite that, CL1, if you look at this price action, is not looking good. So I think it's going to be very hard based on this for the markets overall to go much higher on the back of the economies are very strong. You can do the same with the copper. Copper is not making new highs, definitely not. The price action is pretty bad for this month. What about euro dollar? Euro dollar, I think the chart is still very bullish. The euro is still the same picture. There is a lot of talks of, as we've discussed before, the end of the US dollar. I don't think this is necessarily that. It's just, let's say, less market share. Dollar yen, a bit less of a picture. And finally, I would like to go into the stocks. So stocks looking for the semiconductors, not a great price action. So again, we do have, based on the S&P, based on the Nasdaq, going into the highs of the recent trading range. Having said that, I think what we are missing is the volume. So look at the volume that is here, that is at the bottom. As you can see, we are way below the average. So that tells me that it's not only a question of conviction. It's just that the strengths of those moves are not very, very strong, and I don't see any strong follow-up in the near future. So what about jumping back into what happened for this week? So looking at the S&P futures over the last 5 sessions. So that was Monday, that is Tuesday. Very often Monday and Tuesday after the OPEX, we have a bit of a sell-off, and everyone is putting words and saying this is because the economy is slowing, because of this is the earnings. It's just because people are resetting their options book and they are buying protection, and that means volatility is going higher, and market makers are selling the futures. Then from here onwards, we get market going very well. First reason is the GDP. So we had the US GDP, which was at 1.1% roughly in Q1. So if you look at the details of the numbers, actually the US consumption was a bit below the expectations, but way above what you normally have. We all know these numbers, okay? So looking at the US GDP, anyone that is telling me, oh, the US economy is very strong, most of the retail, most of the consumption was in January, which was due to some taxes, some base effect. But if you look at the overall picture of the US consumer, you are bang on the trend that we had over the last 10 years. Now we do know again that from H2 onwards that the US consumer is running out of ammunition, and this is the time that it will be starting to struggle. So don't give me, our Q1 is good, US consumer is very strong. We know that it's over. What is important is going forward. And as I said, the market is more and more reacting at the last minute. But what is clear is the S&P from Thursday onwards reacted very well, and then we had the follow-up, and very much we went back into the story, which is you do the zero day to expiry, 2 days to expiry with options, a tons of calls. So if you look here, this is for the S&P 500 that was as of yesterday. So we're looking here at the strikes. Here we have those strikes, and we see the volume, and most of the volume you see between 41.60 to 41.75. So the market closed at 41.70. So here I give you the options for the 41.70, and you see the volume, huge volume. Very much market driven by short-term options, and that gives you the squeeze that is from the market makers, and that was true for the session on Thursday and Friday. GDP was okay, not stellar. Then if we look at how the S&P has been doing for the months of April, so here we are looking at the end of March versus the end of April. The S&P was up 60 points, okay, 60 points. And I looked at what has been the weighting, the composition of the winners over this month. So as you can see, Microsoft contributed 20 points of these 60 points. Apple, 13 points. Meta, 8.65, blah, 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 blah. So overall, the FANG, Facebook, Amazon, Apple, Microsoft, and Google made up 54.91 points out of the 60 points of the S&P move. So that gives you 91% of the S&P move for this month. You see that Tesla is underperforming, but that is something that I underlined last weekend. Clearly, the drivers is about looking at how this FANG is doing versus the S&P, and the picture is very much the same. And that goes back into the idea that the market breadth is pretty bad, very few winners. So if we look at both the volume, if you look at the industries that have been outperforming the overall S&P, there are not that many, and it's very much driven by those very few names. So what is happening with passive investment, with everyone doing the same with options? Everyone is jumping into those very few names. So that doesn't give you a good picture about how strong this market here. Finally, looking at the earnings season, picture is more or less the same. The beat for the EPS is around 6%, but keep in mind that the numbers were downgraded by roughly the same amount, by 6% between December and March. So overall, we are beating the numbers, or I should say companies are beating the numbers from a very low level. But the most important part from this picture is thinking that 90% of the S&P move in the month of April was done by those FANG names. So if you're talking about market breadth, if you think that markets need to have a good advance in decline, a good market breadth, this is really, really not the case. So what about the catalyst going into this week? So we're going to have several. We're going to have, so I should have added here that obviously on Monday we get the coronation of the King Charles, very, very important. And then we're going to have PMI, ISM manufacturing in the US on Monday. We're going to have the ISM services on Wednesday, but really the big point is the FOMC meeting. So FOMC meeting where we expect the Fed to be hiking rates by 25 bips. That is roughly priced by 80% more here. And then the ECB on Thursday and Norway as well. So ECB expected to increase by 25 bips. So FOMC, as always with the FOMC, what's going to be important is the press conference. The market, as I said before, is pricing 25 bips here and probably, 30-50% chance on another 25 bips in June. So we are getting closer to the end, but that's going to be very important to look at the combination between what the Fed, what the FOMC is saying, and what is the ISM manufacturing and services are going to be telling us. We know that so far there has been a huge divergence between services doing very well and manufacturing a bit struggling. The news that we had from the flash PMIs from last week is actually manufacturing for this month has been doing a bit better. So instead of having the recession early Q3, it's probably going to be delaying again. Again, very much telegraphed by the Fed. Many market participants are expecting this to be happening. So what about the second point, which is earnings? So earnings, we're going to have a bit less than this week. So this week we had roughly 40% of the S&P market value, whereas for this week it's 22%. We're still going to have some big names. On Thursday we got Apple, and that's going to be interesting looking at the SPY versus the FANG. What about now? Looking at the weekly straddle, we know that selling volatility has been working very well. What is interesting is the market looking at the SPY as of yesterday at the money straddle is pricing a 1.6% move for the week. So think about it, only a 1.6% move for the week when we're going to have, sorry, I should have mentioned as well, the NFP. We're going to have job numbers on Friday. We're going to have the ECB on Thursday. We're going to have ISM services on Wednesday with the FOMC. And on Monday, we're going to have the ISM manufacturing. And despite all of this, we are just roughly up from this week from 1.4% to 1.6%. So the market is pricing very low volatility, both implied and realized, and very much when it does happen is when the market is bullish and when the expectation are for the economy to be doing well. Finally, looking at the seasonality, because this is a new month, so the month of April, so we had the the S&P up 1.5% roughly, which is close to the 1.9% for the last 20 years for the S&P. Normally, the month of May, if you look since 2000, is roughly flattish, okay? But you do have like a bit of seasonality, bad seasonality for the next 2 months, looking into June, where June is normally a bad month. So I'm not going to go into the sell in May and go away, but you have actually a lower seasonality, not a great seasonality going forward. So very busy week where the market is pricing, everything is going to be fine. 1.6% move on the S&P, despite earnings, despite ISM manufacturing, despite... And finally, at the end of the week, we're going to have Bullard and Cook. So going forward, after the FOMC meeting, we're going to have some Fed speakers, and that's going to tell us what's going to happen, what they are expecting to happen in the next few weeks. So this is it for me today. So if you have questions about, the 4x4, how I get this investment process, how I do it, you can learn it. There is a nice video series which is called the 4x4. You can do one-on-one session with me through the mentoring. You can join us on the Discord community where we get roughly 400 to 500 traders now trying to share ideas and how to get an investment process, building the infrastructure and so on. And finally, if you got any questions, you can send me an email or DM me. This is it for me today. I hope you enjoyed it. So very busy week, and I see you in a week time. Bye-bye.